You know that feeling when you go to do something completely normal, rent an apartment, buy a car, maybe just apply for a new credit card with a better rate, and then you get that email or that phone call and the person on the other end says, "We're sorry, but we're unable to approve you at this time." And you're sitting there thinking, "I have a job, I pay my bills. What do they even know about me?" Or maybe the opposite happens. You get approved, but the interest rate they give you is so high that you wonder if you're being punished for something you didn't even know you did wrong. That feeling, that mix of confusion and frustration, and honestly, a little bit of shame, it's more common than most people admit. And here's what gets me. The number that caused that moment, that three-digit number that can open or close doors for you. Most people don't actually understand how it works. Not really, not the mechanics of it. Today, we're going to fix that. Let me start with something that might feel a little uncomfortable to say out loud. The credit score system in America was not designed with your financial well-being in mind. It was designed for lenders. It's a risk assessment tool, a way for banks and credit card companies and mortgage lenders to quickly estimate how likely you are to pay them back. That's it. That's the whole origin of it. Now, I'm not saying that to make you angry or to frame this as some conspiracy. It's just important context. Because once you understand what the system was built to do, you stop taking it personally when it doesn't go your way. You start seeing it for what it is, a game with rules, and you can learn to play it better. Here's the thing most people believe about credit scores. They think it's basically a measure of how responsible you are with money, like a financial report card that tracks whether you're a good person with your finances. And I get why people think that. The way it's talked about in the media, in personal finance content, in conversations with parents, it all sort of implies that if your score is low, you must be doing something reckless. Like you're out here spending irresponsibly, ignoring your bills, living beyond your means. But that's not really what the score measures, not entirely. You could be one of the most disciplined savers in the country, cash in the bank, no debt, pays for everything outright, and have a terrible credit score because you haven't been borrowing money, and the credit score doesn't know what to do with you. On the flip side, someone who has multiple credit cards, a car loan, a mortgage, and a personal line of credit could have a near-perfect score. Not because they're doing anything magical, but because the system was literally designed to reward people who use credit regularly and manage it well. So before we get into the mechanics, I want you to release the idea that your credit score is a judgment of your character. It's not. It's a behavioral profile based on a very specific set of financial data points. Some of them are obvious, some of them are genuinely counterintuitive. And once you understand all five, a lot of things that seemed mysterious will start to make complete sense. The score most commonly used in the United States, the one you'll see referenced in almost every major lending decision, is the FICO score. FICO stands for Fair Isaac Corporation, the company that developed the model back in 1989. That model has been updated many times since then, but the core framework has remained remarkably consistent. Your FICO score ranges from 300 to 850. A score above 800 is considered exceptional. Above 740 is generally very good. Below 580 starts to create real friction in your financial life. And the five components that make up that score are not weighted equally, which is actually one of the most important things to understand. Let's walk through each one. Payment history, 35%. If there is one thing you take away from this entire video, let it be this. Your payment history is the single most important factor in your credit score. It accounts for 35% of your total FICO score, more than anything else, more than how much debt you have, more than how long you've had credit, more than all of that. And when you think about it from the lender's perspective, it makes perfect sense. If I'm about to lend you money, the first thing I want to know is, have you paid other people back? Because past behavior really is the best predictor of future behavior that these models have access to. Payment history looks at whether you've paid your bills on time. That includes credit cards, car loans, student loans, mortgages, personal loans, basically any credit account that reports to the major credit bureaus. And the bureaus in the US are three: Equifax, Experian, and TransUnion. Now, here's where it gets a little nuanced. Not all late payments are created equal. A payment that's 30 days late is bad, but it's not catastrophic. A payment that's 60 days late is worse. A payment that's 90 days late or more can be genuinely damaging to your score, and it can stay on your credit report for 7 years. I want that to land for a second. 7 years. You miss a few payments during a rough stretch. Maybe you lost your job, maybe you had a medical emergency, maybe just life came at you hard for a while, and that information follows you for 7 years. That's not a personal finance failure. That's a structural feature of the system. The good news is that time heals. A late payment from 5 years ago has far less impact on your current score than a late payment from 6 months ago. The recency of the negative event matters a lot. So if you've had a rough past and you've been doing better lately, that progress is real, and it is being recognized by the model. There are also more severe events that live under payment history, things like collections, bankruptcies, foreclosures, judgments. These are obviously more serious marks, and they carry more weight. But the same principle applies. The older they get, the less they hurt you. And most of them eventually age off your report entirely, usually after 7 years, 10 in the case of certain bankruptcies. The practical message here is simple, even if it doesn't always feel simple in real life. Pay your bills on time. Even if you can't pay the full balance, at least make the minimum payment. That keeps the account current in the eyes of the system. A minimum payment on time is a very different signal than a missed payment entirely. Credit utilization, 30%. The second component, and frankly the one that surprises people the most when they understand it, is credit utilization. This is 30% of your FICO score, which makes it almost as important as payment history. Here's the core concept. Credit utilization is the ratio of how much credit you're currently using compared to how much total credit you have available. So say you have one credit card with a $10,000 limit. If you're carrying a $3,000 balance on it, your utilization rate on that card is 30%. Pretty simple math. But here's where the nuance comes in, and this is where a lot of people get tripped up. The general guidance you'll hear, and it's solid guidance, is to keep your utilization below 30%, ideally below 10% if you want to optimize your score. The reason isn't that using your credit is bad, it's that high utilization signals to lenders that you might be stretched thin, that you're relying heavily on borrowed money to get through the month. Whether or not that's actually true for you, that's what the model infers. Here's something that genuinely messes with people's heads. Your credit score doesn't know your payment history on any given card. It only sees what your current balance is at the time your statement is generated and reported to the bureaus. So someone who pays their credit card off in full every single month can still have high utilization showing up on their score, simply because they put a lot of purchases on the card throughout the month and the balance hadn't been paid off yet when the statement closed. This is one of the most counterintuitive parts of the whole system. You're doing everything right. You're not carrying debt, you're paying it off. You're not paying any interest, but your score is being dinged because the snapshot was taken at the wrong moment. The fix for this, if it's something you want to actively manage, is either to pay down your balance before your statement closing date or to request a credit limit increase. If your spending stays the same but your available limit goes up, your utilization ratio goes down automatically. And here's something else that trips people up. Credit utilization is calculated both per card and overall. You could have a total utilization of 15% across all your cards, but if one individual card is maxed out at 95%, that can still pull your score down. So it's not just about the aggregate number. It's about keeping each individual account in a reasonable range. One more thing on this topic that I think is genuinely important to mention. Credit utilization has no memory. It doesn't accumulate over time like late payments do. Whatever your utilization is right now is what gets factored into your score right now. Which means if you've been carrying high balances and you pay them down significantly, your score can bounce back relatively quickly, sometimes within a month or two. For people who feel like their credit situation is hopeless, that's actually a really hopeful thing to know. Credit age, 15%. The third factor is credit age, and it accounts for 15% of your FICO score. This one is less controllable than the others, which is both the frustrating part and, in a way, the comforting part. The model looks at a few things here: the age of your oldest account, the age of your newest account, and the average age of all your accounts combined. Older credit histories generally signal more stability, more of a track record, more data for the model to work with. Think of it this way. If someone walks into a room and says they've been reliably paying back loans for 20 years, that's a much more compelling case than someone who has only had credit accounts for 8 months. It's not about whether those 8 months are perfect. It's about the volume of evidence. The system wants more data points before it extends more trust. This is why one of the most common pieces of advice you'll hear is don't close old credit cards, even if you don't use them anymore. That old card, even if it's sitting in a drawer, is contributing to the length of your credit history. The moment you close it, that account will eventually stop being factored into your average account age, and over time, that can cause your score to dip. Now, I want to be careful here because this advice has nuance. If a card has an annual fee and you're not using it, it might make financial sense to close it. There's a real cost there. But if it's a no-fee card that's just sitting around, there's generally a case for keeping it open, maybe making a small purchase on it once a year to keep it active. Here's the thing about credit age that can be really frustrating for young adults. You cannot speed up time. If you're 22 and you just opened your first credit card, you are going to have a relatively young credit history for a while. That's just the reality. The system inherently rewards longevity, and that means younger people, or people who are newer to credit in America, face a built-in disadvantage that has nothing to do with their actual financial behavior. If you're in that position, the best thing you can do is start now. Open one card, use it responsibly, pay it on time, and let time do its work. Every month that passes is another month of positive history being added to your file. There are no shortcuts on this one, but the passage of time combined with good behavior is a very powerful combination. Credit mix, 10%. The fourth factor is credit mix, and it makes up 10% of your score. This is probably the least understood of all 5 components, and honestly, it's also the one you should probably think about the least in your day-to-day financial life. Credit mix looks at the variety of credit accounts you have. The FICO model generally divides credit into 2 broad buckets: revolving credit and installment credit. Revolving credit is things like credit cards and home equity lines of credit. These are accounts where you can borrow, repay, and borrow again. The balance revolves based on your behavior. Installment credit is things like mortgages, car loans, student loans, and personal loans. These have a fixed payment schedule, a defined end date, and a balance that only goes down over time. The model, at a broad level, likes to see that you can handle both types responsibly. Someone who only has credit cards looks different to the model than someone who has a credit card and a car loan and maybe a mortgage. Not because having a mortgage is inherently better, it's not, but because it demonstrates a track record across different types of borrowing. Here's what I want to be really clear about, because I've seen people get this wrong. You should never take on a loan you don't need just to improve your credit mix. That is a terrible financial decision. The 10% weight of this category does not come close to justifying taking on interest payments, debt obligations, or financial risk just to check a box in a credit model. Credit mix is something that tends to improve naturally over time as your financial life develops. Most people will eventually have a car loan or a mortgage or student loans just by living life. When that happens, your mix improves as a natural consequence. It doesn't need to be engineered. If you have a solid payment history, you keep your utilization low, and you're building your credit age over time, your score will be in very good shape, even if your credit mix is limited. Don't lose sleep on this one. The fifth and final component is new credit, also accounting for 10% of your FICO score. This one covers two things: hard inquiries on your credit file and the recency of new accounts you've opened. Let's talk about hard inquiries first. When you apply for a new credit card, a mortgage, a car loan, or really any kind of credit, the lender typically pulls your full credit report. That pull is called a hard inquiry, and it shows up on your credit report. It has a small negative effect on your score, usually somewhere in the range of 5 to 10 points, sometimes a bit more, and that effect typically fades within a year. Hard inquiries stay on your report for 2 years, but their impact diminishes fairly quickly. Now, 5 to 10 points doesn't sound like a lot, and in isolation, it isn't. But if you're applying for several different things at once, a credit card here, a store financing offer there, a personal loan, those inquiries can start to add up. And the model sees a flurry of credit applications as a potential warning sign. Someone who suddenly applies for a lot of new credit in a short period of time might be facing financial stress or trying to extend themselves beyond their means. Whether that's true or not, that's what the model infers. There is, however, an important exception built into the FICO model called rate shopping. The model understands that when you're shopping for a mortgage or a car loan, it's normal and actually smart to get quotes from multiple lenders. So if several lenders pull your credit within a short window, typically around 14 to 45 days depending on the version of FICO being used, those multiple hard inquiries are often counted as a single inquiry for scoring purposes. This is designed to encourage consumers to shop around for the best rate without being penalized for being financially savvy. The second piece of the new credit component is the age of your newest accounts. Every time you open a new account, it brings down your average account age, which also ties back to the credit age factor we already talked about. Opening a lot of new accounts in a short period sends a signal that you're aggressively seeking credit, which the model tends to interpret negatively. The practical takeaway here is straightforward. Be intentional about when you apply for new credit. Only apply when you actually need something. And if you're about to make a major credit application, like a mortgage, try to avoid opening any other new accounts in the months leading up to it, because every hard inquiry and every new account could potentially affect the rate you're offered. Okay, so we've walked through all 5 factors. Let me now tell you the thing that I think actually matters, not just the mechanics, but the mindset that changes how you relate to all of this. Most people think about their credit score reactively. They only check it when they're about to apply for something. They feel a wave of anxiety when they log in. They either feel relief or they feel shame, and then they close the app and forget about it until the next time they need it. That reactive relationship with your credit score keeps you in a position of helplessness. You feel like the score is happening to you, rather than something you have real agency over. Here's the shift I want to offer. Your credit score is a lagging indicator. It reflects decisions you made in the past. And the flip side of that is that the decisions you make right now are already writing your future score. If you're in a place where your score isn't where you want it to be, maybe you had some missed payments, maybe you're carrying high balances, maybe you just have very little credit history, none of that is permanent. All of it is movable. Slowly sometimes, but it moves. I've seen people turn a 580 into a 720 in 2 years just by doing a few things consistently. Not perfectly, not dramatically, just consistently. Pay on time, lower the balances you can lower, don't open a bunch of new accounts all at once, let time pass. That's genuinely most of it. And here's the deeper thing I want to say, because I think it's easy to get lost in the optimization mindset and forget why any of this matters.
A good credit score is a financial tool, nothing more. It gives you access to better interest rates. It makes it easier to rent an apartment without a cosigner. It might help you get a job in certain fields. It can lower your car insurance in some states. It creates more options, more flexibility, more breathing room. But it is not a measure of your worth. It is not a reflection of your character. It is not a test that determines whether you're good at life. Some of the most financially stable people I've ever read about have mediocre credit scores because they prefer to pay cash for things, or because they went through a genuinely hard period years ago and they're rebuilding, or because they're immigrants who are brand new to the American credit system and starting from zero through no fault of their own. The goal isn't a perfect score. The goal is enough of a score to get you the opportunities you want at rates that don't eat you alive. And for most of those opportunities, a score in the mid-700s is more than enough. There's a real phenomenon in personal finance where people become so fixated on maximizing their credit score that they start making irrational decisions in service of the number, carrying small balances they could pay off because someone told them it helps utilization, keeping accounts open they hate, applying for cards they don't need to diversify their mix. Please don't do that. The score serves you. You don't serve the score. Understand how it works. Be intentional about the things that matter, and then let the score be a byproduct of living your financial life sensibly, rather than a goal in itself.
Let's bring this down to earth. Here are the things that actually move the needle, applied to real life. The single most impactful thing you can do, by far, is set up autopay for at least the minimum payment on every single credit account you have. I know. You've probably heard this before. But the reason it keeps coming up is that it works, and it costs you nothing to implement. You set it up once, and payment history, the 35% factor, essentially takes care of itself on autopilot. A late payment because you forgot, because you were traveling, because the email went to spam, those are the most preventable credit mistakes out there, and autopay eliminates them entirely. On credit utilization, if you're carrying balances right now, try to identify which card has the highest utilization rate and focus your payoff energy there first. You don't have to pay everything off at once, but bringing your highest utilization card from 85% down to 40% can make a meaningful difference, even if your other cards stay the same. Also, and this is worth doing right now if you haven't already, log into your credit card accounts and request a credit limit increase. If you have a decent payment history with the card, there's a good chance they'll say yes. That increases your available credit, which immediately lowers your utilization ratio without you paying down a single dollar. On credit age, the main thing is just don't close old accounts impulsively. I've talked to people who closed their oldest credit card because they were simplifying and then were confused when their score dropped 30 points. If the card has no annual fee, it generally makes sense to keep it open. Use it for a tank of gas every couple of months to keep it active, and then forget it exists. On new credit, just be deliberate. Before you apply for anything, ask yourself honestly, do I need this right now? If the answer is no, wait. If the answer is yes, do your research and try to do your major credit shopping in a short window so you minimize the number of hard inquiries that hit your file. Now I want to talk about something that doesn't get enough attention in conversations about credit scores. Checking your credit reports, not just your score. Your score is a number derived from your credit reports, but your reports, which you can access for free through annualcreditreport.com, the official site sanctioned by federal law, contain all the underlying data. And that data has errors, more often than most people realize. Studies have found that a significant portion of credit reports contains some kind of inaccuracy. Incorrect account information, accounts that don't belong to you, sometimes from identity theft, sometimes just from clerical errors. Payments marked late that weren't late. If there's an error on your report dragging your score down, you have the legal right to dispute it. The credit bureaus are required to investigate disputes, and if the information can't be verified, it has to be removed. This is not a gray area. It's your right under the Fair Credit Reporting Act. So, if your score seems inexplicably low given your actual behavior, it's worth spending an hour reviewing your full credit reports from all three bureaus. You might find something that shouldn't be there. One more thing. If you're completely new to credit, no accounts, no history, essentially an invisible file, the traditional path of getting a credit card and using it responsibly still works. But there are other options now too. Secured credit cards, where you put down a deposit that becomes your credit limit, are specifically designed for people building credit from scratch. Some credit unions offer credit builder loans, which are exactly what they sound like. There are also services now that can add things like your rent payments or utility payments to your credit file, which helps people with thin files start to build a history. None of these are magic. None of them work overnight, but they are legitimate, accessible entry points into a system that was not originally built to be easy to enter. I want to end with something a little more personal because I think the emotional weight of credit scores deserves to be acknowledged. In America, this three-digit number touches so much: housing, transportation, interest rates that could cost you thousands of dollars over a lifetime or save you thousands of dollars. In some states, it can affect your car insurance premiums. Some employers check it for certain roles. The reach of this number is genuinely wide, and that means the anxiety around it is also genuinely wide. If you've ever felt embarrassed by your credit score, if you've ever avoided checking it because you were afraid of what you'd find, or felt a kind of low-level dread whenever the topic came up, I want you to hear this. That feeling makes complete sense. You were never really taught how this system works. Most of us weren't. It's not something that's covered well in school. The language around it is full of jargon, and the consequences of not understanding it can be real and costly. But now you know how it works. You know that payment history is 35% of your score, and that autopay can take that stress off your plate. You know that credit utilization is 30%, and that it has no memory, which means paying down balances creates near immediate results. You know that credit age rewards patience, that credit mix doesn't require you to take on unnecessary debt, and that new credit inquiries are minor and temporary. You know that errors on your report can and do happen, and you have the right to dispute them. And maybe most importantly, you know that this number is not the whole story of your financial life. It is one metric in one part of the larger picture. Plenty of people with imperfect credit scores live financially stable, peaceful lives, and plenty of people with near-perfect scores are carrying tremendous anxiety about money. The score is a tool, it's not a verdict. Whatever your score is today, it is not permanent. It is not fate. It is not a reflection of who you are. It is a snapshot of a very specific set of behaviors over a period of time, and behaviors can change. If there is one small thing you do after watching this video, let it be this. Go check your credit reports, not just the score, the full reports. See what's in there, understand your starting point, and then just take one small step. Autopay on one account, a call to request a higher limit, a dispute on one inaccurate item. One step. That's how it works. Not one big dramatic transformation, just one step, and then another, and then another. And over months and years, the number moves, the options expand, the rates improve, the breathing room grows. Progress beats perfection, every time.